Good afternoon, everyone, and welcome to the Cantor Fitzgerald ETF Portfolio's Economic and Market Commentary webinar. We'll let another minute go by or so before we get started officially here, and then we'll kick things off with Herb Morgan. Okay, good afternoon, everyone, and welcome to the quarterly Economic and Market Commentary webinar featuring Cantor Fitzgerald's own Herb Morgan. Herb is Senior Managing Director and Chief Investment Officer for the Cantor Fitzgerald Managed ETF Portfolios. And these are a series of asset allocation models managed by Herb for the past 20 years. And they are comprised of strategic, tactical, and opportunistic positions designed to provide investors with highly diversified asset class exposure. Earlier in his career, prior to founding Cantor Managed ETF Portfolios, Herb helped reform the San Diego pension system, and he has been featured in various news outlets such as the Wall Street Journal, Forbes, MarketWatch, and more. Additionally, he had a notable appearance on CNBC in early 2020 with a memorable interview called How Can It Not V? And I'd encourage you to look up that clip as well. Herb will spend time today discussing our managed ETF portfolios, where they are currently positioned, as well as actionable key takeaways on the market, and how we got here and what's changed since we were last together. And as a reminder, you can follow Herb's podcast to get his thoughts on a weekly basis. The podcast is called Slaying Bulls and Bears. So thank you so much for taking the time to join us today. My name is Tiffany Orcutt, and I am the investment specialist for our traditional markets business at Cantor Fitzgerald Asset Management. And when we say traditional markets, this is a part of our business that includes our ETF asset allocation strategies, as well as other separately managed accounts and mutual funds across various asset classes. Now, before we jump into the conversation with Herb, I'd love to make a quick housekeeping note. We will be dedicating time at the end of this session for your questions. So feel free to enter any questions or comments in the chat function at the bottom of your screen, and we will get to them as soon as we finish our prepared remarks in the next 25 minutes or so. Now, first, a quick note on Cantor Fitzgerald. Cantor is a company with a proud legacy that has been at the forefront of the financial services industry since 1945. With a tradition of excellence spanning nearly 80 years, Cantor has evolved into a global powerhouse with a footprint that includes 160 offices in 22 countries and a talented team of over 12,000 employees worldwide. Known for its stability, Cantor maintains an investment-grade credit rating from both Standard & Poor's and Fitch, which underscores the sound financial strength of this organization. As one of only 24 primary dealers authorized to transact directly with the Federal Reserve Bank of New York, Cantor clearly plays a critical role in the U.S. financial system. And Cantor Fitzgerald Asset Management is a relatively new division of Cantor Fitzgerald. We're about a decade old now, and we have significant capabilities across traditional and publicly traded markets, as well as private markets and alternatives. Fortunately for us, the asset management arm of Cantor is able to leverage the power and breadth of our broader organization with the resources and the shared services model we have to bring best-in-class investment strategies and exceptional services to financial advisors such as yourselves and your clients. So the financial community has done an amazing job of leaning into education during periods of both calm and when there's uncertainty and volatility in the markets. And when we reflect on the last 10 weeks in the markets, without question, uncertainty has been a key theme. And as a firm that is committed to education, it is my honor to turn it over to Herb Morgan to share some key insights to help you manage your practice and your business and work with clients each and every day. So with that, Herb, the floor is yours.
Hi, Tiffany. Hi, everybody. Thank you very much. I see we've got quite a large number of people tuned in today for Fed Wednesday. Thank you for the great introduction. I'm Herb Morgan. You can follow, if you like what you hear today, you can follow my weekly video podcast on YouTube. It's called Slaying Bulls and Bears. Or I also post it each Monday on LinkedIn, Herb Morgan. You can follow there, or at Herb W. Morgan on the X. Everything you're seeing and are hearing today is developed by me. Yeah, there are many different types of people on the call. Nothing that we say is tax advice, nothing is investment advice, or no recommendation for purchase or sale of any securities. The views expressed are mine and mine alone, may not reflect the views of CFIA's parent affiliates or other portfolio managers on the firm. What I'm looking to do today is to go about 20 minutes, give you sort of an update on the economy, the markets, and then where we see them likely going for, let's say, the remainder of the year and into early 2026. And then we'll get to the questions, and feel free to type them in at any time. Tiffany will call the questions and get those to me at the end. Let's start with the manufacturing side of our economy. This is an important component of the economy to the administration, but it's not the most important in terms of its percentage and its weighting. About 15% of the US economy is manufacturing. The S&P Global US Manufacturing PMI, or Purchasing Managers Index, for February came in above 50. The line of delineation between contraction and expansion is 50. And as you can see here, through much of last year, the second half of last year, we were below the 50 line. Then in both January and February of this year, we went above the 50, which means manufacturing activity increased in the United States in January and February. So when you hear talk about a potential recession, for me, it's hard to imagine a recession coming when you see manufacturing picking up, and manufacturing had been the part of the economic recovery that had been lagging. But the far bigger part of the US economy is non-manufacturing, everything else, or otherwise called services. You can see that it has been above 50 ever since we came out of the COVID-related shutdowns, and some very high numbers above 55. You can see all through 2024. And then the first 2 months of 2025, also above 50. It means the economy, the services sector of the economy, expanded, but it did expand at a slower pace, which to a certain degree is what the Fed is looking for in order to bring down the inflationary pressure. When you start getting high rates of expansion and resource utilization in the economy, let's say north of 55, like here coming out of the COVID shutdowns, close to 60, and you can see recently as December, we were well above 55 as well, and that represents some inflationary pressure. So even though these numbers are lower, not the end of the world. The other part of the economy that's incredibly strong is the labor market. Weekly initial claims for unemployment come out every Thursday morning at 5:30 a.m. Pacific, my time, and anything below 300,000. Now look at this chart, this graph. The highest number I even have on here is 270,000. Anything below 300,000 is seen as maintaining job growth. So in a country with 330 million people, you have people transitioning jobs. Every week, a couple 100,000 people file for unemployment for the first time. When these numbers start to spike and go higher and get above 300,000, that's a sign that you're getting close to entering a recession. When you get down at the low number of 200,000, it's also seen as somewhat labor market inflationary. Rising wages certainly delivers inflation through the other side. And so, as a matter of fact, the Fed chairman talked about that in his comments after the meeting this morning. On a monthly basis, the economy continues to net add new jobs. So that's new people hired minus the 4 weeks or 4.5 weeks of weekly unemployment claims. And the net increase in jobs, as you can see in February, we were up 151,000. It's a great number. We had 1 month last year where we got down to 44,000, but we haven't had a negative month of job creation, meaning job destruction. We haven't had a negative month in several years. The unemployment rate remains at essentially what we call full employment, or about 4%. The other thing we look at to determine the health of the overall economy is the jobs picture. The gold line here, this goldish line that I'm highlighting with my red dot, represents the number of job openings in the economy, or JOLTS as we call it, the Job Opening Labor Transition Survey. The JOLTS number, there's 7.7, almost 8 million job openings. Now, if you just looked at a short chart, you said, well, it's down from 12 million down to 8. That's not good. Well, no, it had to go up big because you remember all the people that got laid off during COVID, then they had to be rehired when we came out of COVID in 2021 and 2022. So we are really back to where we were when the economy was sort of what I would call pretty healthy. When you have job openings, the gold line, when that exceeds the blue line, that's the number of unemployed people in the economy. 7.7 million openings today for 7 million unemployed people. That is not a market that's in perfect equilibrium. So more demand than supply means higher wages, higher prices of any commodity, but higher wages in this particular case. And so that is contributing to some of the inflationary pressures. Admittedly, the gap is not large. The gap was very large coming out of COVID and really significantly contributed to inflation, right? We had that big gap of 12 million openings and only 6 million unemployed. It was 2-to-1 openings for every person. Last week, we got a couple of better than expected reports on inflation. Inflation, I know, is on everybody's mind right now. It is critical to the capital markets. It is critical to government services. It is critical to consumers. It is critical to producers. And when we got those two better than expected inflation reports on the CPI and the PPI, people began to sort of celebrate a little bit in the media. Oh, we've taken care of the problem. We've whooped the problem, if you will. And the reality is we haven't. It was one decent month. In fact, producer prices actually went down 0.1% for the month, but that is not ollie ollie auction free victory. What you see here, what we call inflation break evens. This is the treasury market. The treasury market is the most liquid and most efficient market in the world. So listening to what the treasury markets are doing is an amalgamation of all the most sophisticated traders in the world, and it takes their opinions and it represents them in the yield on treasury securities. If you take the yield on the nominal, I'm going to use the blue line here since it's at the top, the nominal 2-year treasury yield, and you subtract the yield on the TIP, or treasury inflation protected security, the difference in those two yields represents what the market, the deepest, biggest market in the world, believes inflation will be over that period. So the 2-year inflation expectations of the market, who cares what I think? What does the market think? Is 3.13%. The Fed's target for inflation is 2%. So the Fed is in a bind here, and I'm going to get to what that bind is in a moment. The gold line is 5-year break evens. We're at 2.5%. The market believes inflation will come down to 2.5% and average 2.5 over 5 years, and will average about 2.3% over 10 years. That is not price stability. Price stability is the exact wording that was statutorily given to the Federal Reserve after the inflation of the 1970s. The Fed got a new job it didn't have before, and that was maintain price stability. Now, I would say that price stability means 0% inflation. The Fed doesn't see it that way. The Fed says we define price stability as 2% core PCE inflation. So their target is 2. We're at about 2.8, and the bond market believes we're not going down anytime soon. So it was great to get good numbers last week, but we have a problem with inflation. And now that problem of inflation has manifested itself into the stock market, along with several other problems that are creating uncertainty. This is a graph of the S&P 500, and it's a little bit of a challenge to see here, but you can see this was the peak in February, and then this was the trough late last week, and the S&P 500 index has declined about 10%. That's normal. That's healthy. And then the question as investors we want to ask ourselves is, well, is it over? Or will it continue to go down another 5% or 10% and get us to the bear market number of 20%? We also had about an 8.5% pullback last summer in July. The NASDAQ Composite Index, that's down 14% from its high, which was in December. More volatile companies, higher multiple companies. It's expected, of course, they would go down and go up more during those cycles than the S&P 500 would. And then there's the now famous part of our lexicon, everybody's lexicon, and that is the Mag 7. These magnificent 7 companies that are driving the earnings growth, driving the top line growth, driving the innovation of our economy and the future of our society. These companies are down about 20% since their high that they also reached in December. Well, okay, let's talk about that. What has caused the equity sell-off? Let's first and foremost talk about where we were on the price to earnings ratio of the S&P 500. The S&P 500 PE at the beginning of this market rally big in 2023, it was up 20+%, did it again in 2024. At the beginning of 2023, we were at a PE multiple, price to earnings ratio, of 15. When we started this year in January, we were at 22. Well, 15, 22, that's 7 points. That's a 50% increase in the valuation of the earnings. So you take, we call that multiple expansion. Now, if you follow my weekly podcast, you know that all through December and January, I was screaming, you can't get more PE expansion. 22 is at the higher end. We're not going to 31, which would be another 50% PE expansion. We're not going to go to an S&P that trades at 31 times earnings. So the best case scenario for 2025 was just okay returns or flat returns. Let's take our dividends and be happy. But then in the first quarter, as companies reported their earnings from December, they began to give more than normal downgrades of their estimates for future earnings. This happens every January. Companies report, they say this is what you can expect from us this year, and they try to push it down. Why do they want to do that? So that they can satisfy investors in the subsequent 3 earnings reports. They want to underpromise and overdeliver. So we expect guidance to go down every January. However, this January, it went down more than it normally did. So that contributed to the sell-off in equities. Then you've got this issue around this economic transition. And I think this is the biggest part of what's driving the volatility, the downward moves, the declines, whatever you want to call it. I know a lot of people get annoyed when we call it volatility. It means my account value is going down. But this economy, the American economy, the largest, most productive and robust and freest economy in the world, is going through a major transition, unlike anything we've seen in the post-World War II economy. What we are doing is weaning ourselves off of, you could call them drugs if you will, but off of what I call violent intervention into the economy. When a central bank, when an authority cuts interest rates or raises interest rates, that's not the market making things happen. That's an intervention into the market. That's monetary policy. Fiscal stimulus, when the government says we're going to build the Hoover Dam, and because the economy wouldn't deliver the Hoover Dam naturally, that's intervention in the economy. And that's how our economy has been run for a very, very long time. We've gotten to the point where we either can't do it that way any longer, I'll address that in a moment, or we just don't want to do it that way any longer because we want to move towards a more free market, capitalist oriented economy, which relies on the free will of market participants to invest and move their capital with some tools that will gently encourage market participants to move their capital to the US. So the new stimulus won't be deficit finance fiscal spending or direct checks and payments to individuals. The new foreign direct investment is the new stimulus. This is the new stimulus. So capital investment by domestic companies and then foreign direct investment. And the transition of the economy away from monetary and fiscal stimulus anytime the market goes down a little bit, I don't know how bumpy that will be. I know it will be bumpy, and it has been so far. The question is, how much more difficult will this transition be? If you go back to 1981, 82, when the Fed just sort of cut interest rates, that was similar in a way because we had to whip inflation. And to whip inflation, we just raised interest rates so much that we created a recession, and we had this Keynesian style reduction in demand, which took care of the inflation problem. We're not doing that this way. This is a total transition to more capitalism. So this is the chart I told you about, the guidance downward of earnings estimates. This is the earnings estimates for the quarter we're in, the quarter that ends in 2 weeks or 10 days. And you can see back in late January, we were expecting, $62.75, $63 total earnings for the S&P for the quarter. That's now down to $59.72. That's not end of world. That's not a huge percent, but normally you start here and maybe you go down to 61.50. So it is a bigger than normal thing. All that being said, though, corporate profits, which is this graph here, continue their upward trajectory. These red bars represent recessions, right? This is the 01 recession, global financial crisis, 08 recession, very brief COVID recession. But one of the things that is, to me, worth noting on this graph, you see this blue line, how the rate of change, the second derivative, if you will, it's going higher faster. And that defies a lot of logic. We think, well, the economy of the US is so big, it's the Titanic. How can you steer it? How can earnings grow so fast? Part of the reasons earnings grew so fast is interest rates were so low, so balance sheets could be levered. But I think the bigger reason earnings are growing so fast is because of innovation. And at the forefront of innovation are things like artificial intelligence. So that justified that higher PE multiple I told you about of 22. By the way, it's been now down to 20 since the market has corrected. So I want to be careful. I've been saying we're getting a market correction. Now we've got one. I'm not saying the economy is going to be in a recession. I don't think that's likely, but we'll talk about how it could be as we continue to progress, hopefully logically through this. As stocks have come down, they've become more valuable, right? It's real simple. The market PE, if you turn it over, it's E to P, earnings divided by price. The market earnings yield, earnings divided by price, is about 4.1%. And then the yield on the risk-free US Treasury is 4.3%. Typically, you would want the earnings yield of stocks, that's the purple line, to be above the risk-free yield. After all, stocks are risky. Stocks are more volatile. US Treasury securities are not risky. And as they get close to maturity, the volatility just goes right away and they mature, and it's guaranteed by the full might of the United States of America. So we're closer to that today, but we're still a little overvalued, at least by this metric. But I want to go back and make sure everybody understands the significance of the transition. The economy is transitioning. How the economy is run is transitioning. It's transitioning away from this over-reliance on state intervention to a reliance on the private sector. In the long run, I believe that is fantastic news for equities, for equity investors, for pension plans, for all of those things. But in the short run, the market has to say, well, how do we handle that? How do we price that? That is an increase in uncertainty. That's something that Tiffany said at the beginning, and that is a fact. Let's go back to the last two big chunks of Keynesian stimulus. And I've used that term, classic Keynesian, a couple of times. He was an economist, a British economist, upon which most economic textbooks are written today. And he had this theory. When your economy slows down, you need to stimulate it. One way to stimulate it would be to build infrastructure projects like the Hoover Dam. You borrow money to do that, you build it, there's a return, but more importantly, there's money that circulates through the economy. In recent years, that Keynesian view has changed to say we could just give people money. We don't have to actually ask them to build the Hoover Dam. Or we could just pay this man here to dig a hole. And then when he's done digging the hole, we could pay him to fill the hole back up again. And that money would circulate through the economy. And in a way, it's kind of true. And in 2008, the most significant, unless some people on here were alive during the Great Depression, the most significant economic event of our lifetime was the global financial crisis of 2008. The fiscal response to that was $700 billion TARP plan, an $800 billion American Recovery and Reinvestment Act, and total stimulus fiscally of $1.5 trillion. Now, the US Treasury didn't have $1.5 trillion lying around to spend, so they went to the bond market and they borrowed that money. So that increased our debt, it increased our deficit, but it stimulated the economy. The famous CNBC interview that Tiffany referred to, How Can It Not Be, talked about exactly that. Then, as we were slowly coming off of all of that stimulus, we decided, we have this other crisis, this is COVID. And they said, it worked so good last time, let's do it this again, but let's do it even bigger. $2.2 trillion CARES Act, $900 billion Consolidated Appropriations Act, and another $2 trillion American Rescue Plan. Total fiscal stimulus this time was $4 trillion. And because the Treasury had a willing partner in the central bank says, oh, by the way, we'll buy all the bonds you need to sell so that you can spend all that money to prevent a deflationary spiral. And they were able to borrow this money at 0.5%, 0.7%, and dumped it immediately into the economy. Remember all the checks we got? People would get, why am I getting a check? Here's $2,000. Debit cards were sent to people in the mail. Well, inflation is always and everywhere a monetary phenomena, right? If you print more money, if you have too much of it, its value goes down. If you have too many oranges or too many eggs in the grocery store and you want to move them, you lower the price. Well, when inflation goes up, that's a lowering of the value of money, of your money. In addition to the fiscal stimulus, we had monetary stimulus for both of those crises. In 2008, we cut interest rates from 5.25%, we're at 4.5% today, by the way, that's the Fed funds rate, to 25 basis points, just 25 basis points. And in addition, the Fed bought, looks like right about the same amount as that fiscal stimulus, right? The Fed bought those bonds and drove interest rates to almost zero. And that set us up for an amount of inflation. But the bank failures were so deflationary at the time, we didn't really see it. And by not really seeing it, we thought, oh, maybe all this doesn't cause inflation. I don't say we, they thought maybe all this won't cause inflation. So when 2020 came around and we had COVID, we had 2.5% Fed funds rate, and we took it back to that 25 basis points, stayed there for 2 years, and we went out again. We bought the bonds, so $5 trillion. So the Fed printed money, which they can do, they're a bank. They bought the bonds, they drove the interest rate down, and this led to very significant inflationary pressure. So much so at the time that I was chirping about it. Nobody asked me, nobody listened to me, but they said, this is great. We have a new theory. We're going to call it modern monetary theory. We can print as much money as we want. We can spend it and beautify our country and build infrastructure and just give it to people that don't have money so they can buy things. And we can do this forever and it will never have a negative impact on our economy. That theory was espoused by members of Congress, by academics, by economists, and then the inflation shot up and ruined their theory. This graph represents the annual deficit created by spending more than you take in, right? The annual deficit of the US Treasury. There were 4 years in the 90s or 5 years rather, where there was an actual surplus. But what's become concerning here, this is, '08, this is 2020, but post 2020, there has been no return to more normalized, let's say 2% deficits. America is one of the only countries that can run a small perpetual deficit because of its position as the world's reserve currency. That's an entirely new webinar. But the deficits are getting larger and larger as a percentage of GDP. Last year was 7%. Accumulating those deficits, each annual deficit adds to the national debt. The national debt back in the 1980s was approaching 40% of GDP. Economists were worried it could be catastrophic. The national debt now is 122% of a $30 trillion GDP. And the question among economists is, when will the bond market tell the government to stop? In other words, when will they drive interest rates too high? Monetary stimulus, therefore, is not an option, and neither is fiscal stimulus. These are the inflation break evens I talked about earlier. So I'm going to skip that chart. I guess I put it in there twice. With 6.7 trillion on the Fed's balance sheet, we're moving away. Then on the fiscal side, in addition to saying we're not going to do more fiscal stimulus and we're not going to do more monetary stimulus, we can't, because inflation won't go to our target. It's above our target. And in fact, one of the reasons it won't go to our target is because of the 7% fiscal deficit. We announced a new government agency called the Department of Government Efficiency, or DOGE. So no matter how you slice it, fiscal stimulus is off the table. Monetary stimulus is off the table. The president and the Secretary of Commerce have said we're going to balance the budget. Now, I don't think that's true. I don't think we will have a balanced budget this fiscal year or next fiscal year. But I do think it would be helpful for the capital markets and our investors if the budget deficit were significantly reduced and at the same time GDP went up, so that debt as a percentage of GDP began to decline. And quite frankly, no matter who won the election last time around, this had to be addressed, or the markets would have eventually imposed this onto whoever was in the administration. So what are they trying to do to transition the economy? We can't just print money. We can't have massive deficits. Number one, they're trying to take what they can out of the spending that is wasteful, fraudulent, or abusive. Fine. It looks like they've identified about $115 billion so far. That's good. That's a start, but that's a drop in the ocean compared to the size and scope of the problem. So on February 25th, the president signed National Security Presidential Memorandum aimed at promoting foreign investment. So investment, foreign and private, is the new stimulus. This is the replacement for monetary and fiscal stimulus. That is the objective of the administration. And I believe that Congress is on board with that. Creates a fast track to facilitate specific investments that we want, expedites environmental reviews for any investment over $1 billion, restricts outbound investments to China, encourages passive investments, so just people investing in projects in the United States. All of this is meant to stimulate economic growth, to grow our way out of the debt, the accumulated debt problem. So historically, let's look at the last couple of years, about 70 billion a quarter in foreign direct investment. These are the things that have been announced so far this year: Taiwan Semi, Siemens, SoftBank, Apple. That's a domestic company, obviously. But these are big numbers. They are of significance to the markets, and they are of significance to future earnings and to growth. But as I've said all along, we're in this transition period. That gets me to the end of my prepared remarks. We've got some time for Q&A, so I'll ask Tiffany that. And don't forget, you can listen to me on the YouTube and all these other things every Monday, no charge. Okay, back to you, Tiffany.
Thank you so much, Herb. That was incredibly insightful, as always. I especially enjoyed that picture of the printing of money, and I thought that slide really helped put things into some context for us. So we do have several questions. Going back to Doge, curious about the impact of Doge on federal agencies and employment and how that might impact some of the labor statistics in terms of the cuts they're making.
Yeah, for sure. Right. So the formula for, and a great question, and thank you for it. The formula for GDP is consumption plus investment plus government spending without any sort of qualification, right? So if the government just pays for a contract to do a study on, some of the things Doge is finding not really appropriate for government, perhaps in some opinion, that's GDP, right? So when you stop some of those, that would be a subtraction from GDP. When you reduce the labor force, that's fewer people employed, that's fewer people doing spending and consumption and all of those things. And that's why I say it's a transition. On the one hand, these things are essentially a form of austerity. But on the other hand, we don't have a choice given the level of debt and deficit. So we're scrambling to try to replace that. Now, there's this thing called the multiplier, right? And when the government spends a dollar in whatever form, it may circulate through the economy and create $3 of GDP. I'm making up the number, right? It could be the government buys a battleship that might circulate through 5 times. All economists who study this would agree that a dollar of government grant, just giving a dollar to a person like we did in COVID, is a lower multiplier to GDP. And then maybe a defense spending dollar to maybe a grant to a nonprofit to study something, versus if a foreign company brings $100 billion into our economy and builds a semiconductor plant in Arizona, that multiplier might be 10, 12, or 15. Is this a certainty? No. I mean, this is the game we're in right now. And we hope that we only cut the things that are truly, wasteful fraud we don't need, and we get better government services in the end for our citizens. That's what we hope. And we hope that the administration is successful at attracting capital, more capital to our country. That is really what they're trying to do with the tariffs, by the way. They're trying to force capital into the United States.
Thank you for that. That does make sense, Herb. Thank you. And this is a question we got in advance, and I think we touched on this a little bit. But given the increased volatility we've seen, and with respect to the chaotic headlines that seem to be circulating around, I know you're not forecasting a recession per se, but the question is, has the probability of a market, maybe a deeper correction or a recession increase? And what are your thoughts there?
Yeah, great question. So definitely the risks of recession are going up because, again, back to the formula, right? If you cut government spending, I don't know that we're cutting government spending this year. I think we're going to cut the rate of increase of government spending. Maybe the Fed cannot cut interest rates further, and I just got through listening to the chairman Powell. So I don't think there's much risk. We have this very strong labor market. We have unbelievable innovation, tech, AI. The earnings for the Mag 7 are going to continue to be great. Doesn't mean it can't happen, right? We had an exogenous shock recession that was created in 2020 with COVID. Nobody who predicted a disease, right? So I don't think that's likely, but I do think it's slightly elevated because of what's happening. The other thing that might happen is, because of all the noise and the uncertainty around the tariff implementation and what that is so misunderstood what that policy is. The policy is to attract capital investment to the United States. And I know sometimes they don't even say what the policy is. They say two different things. I get it. These are not the greatest communicators, but that could cause some people to just sort of hold back. I want to hold back on my spending. I want to hold back on my investing until I see how this all shakes out. We've actually started to see that in consumer behavior so far this year. I don't think it's enough to move the needle towards recession. The second part of your question about a correction, yeah, stocks are still expensive. We're still in uncertain times. We still have crazy things going on. So yeah, I said we could get to 15, 17, something like that from that peak. And I still think that's very possible.
Understood. Understood. And I know you spoke about tariffs too, but maybe just to close, we did get the question in advance as well. What are the biggest policies you see impacting the economy, and what threat do you see to the Federal Reserve?
Well, the biggest policies are going to be whatever comes out of the House from a tax and spend, which we expect soon, right? And it's going to be similar to what we saw in the Tax Cut and Jobs Act of 17, right? The Tax Reform Act of 86 and the Tax Cut and Jobs Act of 17, two most substantive pieces of legislation in our lifetimes from an economic perspective, not only economic perspective, very substantive. They're going to come up with something equally as substantive. And I think the focus, there's going to be some modest tax cuts, the tax on tips and the overtime and all that, which is great. Perhaps raising the bar to which anybody pays income tax at all. Howard Lutnick, the Secretary of Commerce, our ex-boss, talked about 150,000 pays no income tax at all. I'm not sure he had the authority to say that when he did. I thought that was funny. But in terms of the risk to the Fed doesn't have any tools. I mean, they have some tools, right, for emergencies and lending facilities and credit facilities, but the Fed can't cut interest rates if inflation doesn't go down. And the Fed can't go out and buy bonds to lower interest rates. So what the Fed did today, so we're not going to cut interest rates, but instead of letting our balance sheet deprint 25 billion a month of treasuries, we're going to deprint only 5 billion a month. And we're going to continue to deprint 35 billion a month of agencies and mortgages. So we went from some 60 billion a month of money shredding, because they still have to get the money out that they put in that caused all the inflation in 2020. We were shredding 60 billion a month. It was progress. We're going to reduce that to 40 billion a month. That was the only thing they did today, really, of any substance. Their risk is that the market stops giving them as much credibility as they've had, because the market begins to understand they're in a pickle and they can't do anything. The Congress needs to act, and the federal bureaucracy needs to act. We have to get the debt and deficit under control. That's the biggest risk to our portfolios.
Thank you for that. And I certainly think those are very real risks. We did have a few more questions come in. There was a question about whether there will be a replay recording distributed. The answer is yes. A couple more questions here. Excellent insight, Herb. With large cap growth so very overvalued with respect to the forward PE, do you see this factor underperforming and large, mid, and small kind of coming into their own and being stronger for the remainder of this year and maybe into next?
Well, who knows, right? So there's an old expression, the market could be wrong longer than I could stay solvent. And so I think large cap growth, look, the Mag 7's already down 20%. NASDAQ's down 15, the S&P's down 10. The forward multiple on the S&P is down from 22 to 20. I own small, I own mid, but the earnings growth is coming from massive companies, right? Massive companies. These Mag 7 is where it's at. This is the AI boom. They will benefit the cost savings from the implementation of AI. So I wouldn't try to figure that out. I would be owners. I don't try to sell it in front of a bear market. This is Herb's investing rule 101. Don't preempt a market move, no matter how high your confidence level is. And my confidence level, if you listen to the podcast, was very, very high in December and January, but I can be wrong, right? So you never preempt a market move. Instead, you react to the market move. And the way you react to the market move is when you get, hey, I predict 15%. But when I get to 15%, I need to be planned to either increase my equities, add cash, rebalance to target. That's the better play than trying to make big absolute moves. There's old money managers and bold money managers, but no old bold money managers. Stick to your plan. Don't worry about the value on a statement or a screen on a given day or a week or a month. It's not really that important. What's important is you get growth over time.
Good pearls of wisdom there. Thank you so much. And one final question, I'd be remiss if I don't ask it. Going back to the tariffs conversation, the question is, Why would the tariffs not serve as a tax and essentially increase inflation and then pressure interest rates? Can we dig into tariffs a little bit more there before we wrap up?
Yeah, I mean, sure, sure. If you go back and you dust off your international econ book from my lights are going out. Sorry. You dust off your international econ textbook from undergraduate. Tariff, ceteris paribus, everything else in the world being equal, it just is a tax and it adds cost, which is therefore inflationary. No question about it. Our tariffs are on again, off again. Our tariffs are the plan of this administration is, or at least the stated plan is, they're meant to be reciprocal. So, for example, if in Europe there's a VAT, well, okay, that's a 20%. That's essentially a 20% tariff. If it's a 20% VAT, you can avoid that. You can avoid our tariff if you actually capex and build a plant in Tennessee. So this is, remember, I think the primary objective is to deliver capital and attract capital to our markets. There are plenty of instances where, in addition to it being inflationary, there's a national security issue on a tariff, right? So, I don't know, something we need for national security, steel. And when you have a competitive nation who's maybe subsidizing the industry, maybe they're not tariffing ours, but they're subsidizing, which has the same impact. Our view is to try to get it to the point, and I think the president is lousy at articulating his view, but I actually understand his view. And his view is he is, in the end, a free trader. The Secretary of Commerce, in the end, is a free trader. I don't think Peter Navarro's a free trader, so I think it's funny that they're all together. But we will have some level. They will have an additional impact on the inflation trajectory in the short term.
Got it. Last
Yep.
question for you. Do you have an
Mhm.
opinion on growth over value right now?
Well, yes. And this is now a permanent and stationary opinion because value was really defined by Benjamin Graham back in the old Graham and Dodd days. And we all studied this in college. And how do you value a company? Well, you add up the value of the assets, these machines and factories, and add back the depreciation. What is a 20-year-old tortilla press worth at the factory of this tortilla company, right? Well, now we have such economies of scale that result from software, as an example, right? What are the assets of Microsoft? We don't have a traditional way to discount that. So now value is morphed, and value has become discounted present cash flow to the present value, or discounted future dividends to the present value. And so it's not, the growth versus value is not the growth versus value of 1980. It's a totally different game. And so, in my opinion, it's all about growth, right? It's really just this transitioning of our economy, the 5G. We have an administration that's not likely to be particularly aggressive on antitrust to hurt that growth or to pierce the moats that are around companies like Microsoft, YouTube, Google, et cetera, Salesforce. I mean, there's no barrier. Nobody's going to go out and compete tomorrow with Microsoft. You're not going to change your spreadsheet or PowerPoint. It's not going to happen. So I'm not a big rotator from growth to value. I want to own the earnings growth. I don't want to pay too much. So let's call it GARP, growth at a reasonable price.
I like it. Well, in the interest of time, ladies and gentlemen, we'll stop there. Herb, thank you so much. For any additional questions we have in the queue, we will be sure to have your Cantor Fitzgerald Regional Director reach out to each of you individually offline to ensure you have everything you need from us. I'm happy to assist in arranging any follow up discussions with Herb Morgan, as is your salesperson. Thank you all so much for joining us, and we look forward to continuing the conversation with you on behalf of Herb and myself. Thank you so much for spending time with us this afternoon, and have a great rest of your day. Thank you, Herb.
Bye, everybody.